What if I told you that a conflict thousands of miles away could affect your mortgage payment here in Texas? Sounds crazy, but that's exactly what markets are trying to figure out right now. Because when global events impact oil prices can impact inflation. Inflation can impact bond markets, and bond markets can impact mortgage rates. Today, I'm going to connect those dots and explain why every homeowner, buyer, seller, and investor should be paying attention. I'm Kyle Grimshaw, and this is the Texas Market Brief. Good morning and welcome back. I'm Kyle Grimshaw with the Grimshaw Home Group. Today is Monday, June 8th, 2026. If you're a homeowner, buyer, seller, investor, business owner, or simply someone trying to make sense of the economy, you're in the right place. Today, we're talking about why events halfway around the world may affect your mortgage payment and what happened with rates last week. Also, what Texans should be paying attention to this summer. Let's jump in. Let's start with one story Texans should be watching this week. The conflict in Iran continues to evolve, creating uncertainty throughout global energy markets. Now, before anybody clicks away, no, I am not about to put Subway Surfers gameplay next to a lesson on geopolitics. It's just not happening. Younger viewers are just going to have to lock in for a minute, okay? Here's why this matters. The real issue right now, it isn't politics, it's oil. Markets continue watching disruptions tied to the Middle East, including activity surrounding the Strait of Hormuz. This is one of the most important energy shipping routes in the world. A significant portion of the world's oil supply moves through that region. And when markets become uncertain about supply, oil prices can become more versatile and volatile. Recently, we've seen oil trading around the mid-$90 range as investors try to determine whether supply conditions will improve or tighten further. Now, let's connect the dots. Higher energy prices can increase transportation costs. They can increase manufacturing costs. They can increase operating business expenses, and ultimately, they can contribute to inflation. That's where this story starts becoming important for homeowners and home buyers. Last week, we talked about the biggest mortgage myth in America. Remember, the Federal Reserve does not directly control the mortgage rates. The bond market is often the bigger driver. And right now, energy prices are one of the variables bond investors are watching closely. If investors believe higher oil prices could lead to higher inflation, then they may demand higher yields on Treasury bonds. And when Treasury yields rise, mortgage rates often follow. Mortgage rates averaged approximately 6.48% last week, according to Freddie Mac. That's slightly lower than the previous week's reading. However, that data came before Friday's stronger than expected jobs report fully worked its way through the markets. Now, investors are looking at several major questions: a strong labor market, inflation concerns, energy uncertainty, and global geopolitical risk. That combination can create pressure on Treasury yields. And if Treasury yields remain elevated, mortgage rates may remain higher than many buyers are hoping. And as Texans, we should probably pay more attention to energy markets than most people. Energy isn't just another industry here. It's one of the biggest economic drivers in the state. When oil prices move, it can affect jobs, business investment, state revenue, consumer spending, and eventually housing demand in certain markets. That's one of the reasons this story matters more in Texas than it might in many other parts of the country. When energy markets move, Texans often feel the effects sooner and more directly. Now, let's bring this back home. Across much of Texas, buyers continue having more options than they did during the pandemic housing frenzy. Builders remain aggressive in many communities. Incentives are still available. Negotiations are happening more often, and buyers generally have more leverage than they did a few years ago. In Austin specifically, we're seeing a market that rewards realistic pricing and strong presentation. Homes are taking longer to sell. Buyers are taking more time to make decisions, and the market has become much more price sensitive. The days of putting a home on the market and receiving 15 offers by Monday are largely behind us. And honestly, that's not necessarily a bad thing. A balanced market is generally healthier than a market driven by panic and fear of missing out. Here's my take. One of the biggest mistakes people can make is focusing on only one headline. Some people watch the Federal Reserve. Some people watch inflation. Some people watch mortgage rates. And some people watch oil prices. The reality is, all of these things are connected. Housing doesn't exist in a bubble. The economy doesn't exist in a bubble. And that's exactly why I started this show, to help connect the dots. Because sometimes the story that affects your mortgage payment doesn't start in Washington, and it doesn't start here in Texas. Sometimes it starts halfway around the world, and whether you agree with the politics behind the story or not, markets don't care about opinions. Markets care about outcomes. And those outcomes eventually show up in interest rates, housing prices, investment decisions, and household budgets. This week, I'm watching 3 things. Number 1, oil prices. Number 2, 10-year Treasury yield. And number 3, inflation expectations. If energy prices remain elevated, markets may continue worrying about inflation. And if inflation remains sticky, mortgage rates could stay higher for longer. That's something every buyer, seller, and investor should be paying attention to. If you found today's update helpful, make sure to subscribe. And let me know in the comments, do you think mortgage rates will be lower or higher by the end of 2026? I'm Kyle Grimshaw with the Grimshaw Home Group. Thank you for joining me for another episode of the Texas Market Brief. Have a great week. I'll see you on Wednesday.